Good morning, it's Thursday the 5th of October here in London. This is the Bloomberg Daybreak Europe podcast. I'm Caroline Hepker.
And I'm Stephen Carroll. Coming up today, Barclays analysts say it will take a stock crash to rescue the bond market.
Rishi Sunak tears up a project championed by 5 of his predecessors in a bid to reset his party's agenda.
Plus, as the downturn in the property market is hurting owners and landlords, the imminent danger may be elsewhere. We look at the struggles facing the firms who get things built.
Let's start with a roundup of our top stories. Global bonds are doomed to keep falling unless we see a sustained slump in equities. That, according to analysts from Barclays. The global chairman of research at the bank, AJ Rajadax, says that in the short term, the only scenario where bonds rally materially is where risk assets fall sharply in the coming weeks. Yields hit levels not seen since 2007 yesterday, but then rallied on weaker US jobs data. Invesco Stephanie Laracilliere says that traders are watching the current moves closely.
Investors starting to take note, yields that we haven't seen in over a decade. I mean, every part of the curve is at a decade plus highs. And we're talking about a muni market where, in the past, when we have seen these yields, they've usually meant that there was some underlying fundamental questionable, credit issues. And that doesn't exist right now.
Stephanie Laracilliere's comments come as traders remain on high alert for a resurgence in volatility, especially if US non-farm payrolls data on Friday come in stronger than expected.
Bill Gross, the co-founder of PIMCO and a man once dubbed the Bond King, has also been weighing in on the recent market gyrations. He says stocks are clearly overvalued and that bond yields will need to fall significantly to justify current valuations. Speaking to Bloomberg, Gross also took aim at retail investors, saying they've also helped to spook the market, acting as, quote, little bond vigilantes.
They've been spooked over the last week or so by declines of 2, 3, 4, 5% in their ETFs. And so I think they're joining the crowd in terms of selling. And, we're seeing a little bit of an oversold market here headed to 5%.
If you want to hear that full interview with Bill Gross, you can get it on the Bloomberg Talks podcast. All of our key conversations in one place. Redemptions by individual investors have helped to deepen the rout over the past week as exchange-traded funds were forced to sell holdings worth hundreds of millions of dollars.
Now to the UK. After days of criticism for not making a decision on HighSpeed Rail 2, the Prime Minister has confirmed that he's scrapping the northern leg of the £100 billion infrastructure project. Sunak made the announcement in his leader's speech at the Conservative Party conference and sought to frame the move in a positive light.
I say to those who backed the project in the first place, the facts have changed. And the right thing to do when the facts change is to have the courage to change direction.
Rishi Sunak says that he'll spend the £36 billion saved on hundreds of other transport schemes instead. But decisions to cut the project short go against the past 5 prime ministers, all of whom backed the plan. David Cameron reacted to the news, calling it the loss of a once-in-a-generation opportunity.
Barclays is laying off roughly 50 senior dealmakers as part of its annual staff cut. The move is said to be part of a plan to trim headcount by about 300 people across the corporate and investment bank divisions. That amounts to about 3% of the total headcount in the unit, which also includes Barclays trading operations.
The London Stock Exchange CEO Julia Hoggett says the City of London is being hamstrung by low salaries. The finance executive says that luring top recruits with market-changing talent needs pay to match.
That person who would be game-changing in terms of unlocking that value for the UK company, unlocking that market, would have to be paid more than the CEO and wouldn't be able to have any performance-related pay on top of what they started at. And is probably still taking a pay cut from what they'd be paid to work for an Asian company or a US company or even sometimes a European company.
LSE CEO Julia Hoggett speaking there to the In the City podcast. Median pay for FTSE 100 CEOs increased by 16% to £3.9 million last year. And you can listen to that whole interview wherever you listen to your podcasts.
European Union diplomats have reached an initial agreement over an overhaul of rules on migration. Officials agreed that in a crisis situation, member states may request the relocation of asylum seekers to other EU countries, as well as financial contributions to support migrants. Asylum and migration have become an increasingly urgent problem for European Union leaders, meeting in Granada in Spain this week, with some countries taking unilateral measures to tighten controls.
And finally, the 2030 Football World Cup will take place across 6 countries and 3 continents. Spain, Portugal and Morocco will stage most of the tournament, but it will start in South America to celebrate 100 years of the competition, with Uruguay, Argentina and Paraguay hosting a match each. The FIFA president, Gianni Infantino, says that the choice of Uruguay is significant.
The first of these 3 matches will of course be played at the stadium where it all began, in Montevideo's mythical Estadio Centenario, precisely to celebrate the centenary edition of the FIFA World Cup.
Infantino went on to say that the organisation is, quote, bringing everyone together by awarding the competition to so many nations.
Caroline, welcome back. Nice to have you back sitting beside me after your trip to Manchester this week. So much happened, of course, culminating in this speech by Rishi Sunak yesterday. Yeah,
listen, it was great to be in Manchester. It was difficult to get back, of course, because there was strike action. And so that was one of the things that was sort of overhanging the last day of this 4-day conference up in Manchester. It's a huge jamboree. It's all the MPs, it's the Prime Minister and Chancellor giving major speeches, and it's all the party activists there. It's sort of meant to rally the grassroots of the Conservative Party. And so there was a lot of anticipation around what the Prime Minister was going to say, and there was a lot of speculation about HighSpeed Rail too. This is a huge infrastructure project that was meant to end with super fast bullet trains coming into Manchester Station. Speculation that was going to be scrapped, and indeed that is exactly what the Prime Minister did in that speech. He cancelled it. He did talk about reinvesting all of the money in hundreds of other projects, road and rail, in the north of England and the Midlands. But there was really a furore after that. And so I spent the afternoon after the Prime Minister's speech going to the press conference held by the Greater Manchester Mayor, Andy Burnham. He was surrounded by...
who you'd spoken to earlier in the week about this issue.
Absolutely. I had spotted him roving around the conference hall, speaking to people. He's obviously a Labour politician, but, was welcome in the Conservative conference to his city. And so I caught up with him then in a one-on-one conversation. The palpable frustration and really anger, because Burnham was surrounded by a number of business people and also the chair of the Greater Manchester Business Board, Lou Caldwell, who's herself an entrepreneur. So I spoke to both of them. And there was real sort of anger. It doesn't help build business confidence, what Andy Burnham was saying. He didn't understand how the Conservative Party could call itself the party of business or bring growth to the regions, that they didn't. The particular point they made again and again was that Rishi Sunak was in the city to make the decision affecting the city and did not consult business people or himself in the city when he was there. So there was a real sort of anger about that Prime Ministerial government decision, and seems to be potentially building to push back.
Yeah, look, it's something that we're going to be hearing plenty more about as well, and the ramifications of that decision being made, and whether or not party members from the Conservative Party and indeed voters will buy the alternative plan that Rishi Sunak put forward in his speech yesterday. First, we're going to turn to the markets and bring you more of our interview with the PIMCO co-founder Bill Gross. After that historic sell-off that we've seen on bond markets, driving yields to their highest level since 2007. The man known as the Bond King says the market's looking a little oversold. Bill Gross has been speaking to Bloomberg's Katie Greifeld and Romain Bostick.
I think PE ratios are coming down. Katie explained it in terms of an equity risk premium being close to, basically the bond market, and meaning that there's little risk in terms of stocks relative to treasury bills or short-term treasury notes. I would put it this way. Give me 30 seconds for an example that a PE ratio at 20, turn it upside down as an EP ratio at 5, so an earnings ratio at 5. A PE ratio of 20 was a year and a half ago, and since then, real yields, as Katie pointed out, have gone up by a good 350 basis points. If, and I'm not saying this is going to happen, but if the earnings yield ratio, the EP ratio, went up from 5 to 8.5%, then PE ratios would be down around 12 or 13. Now that's a little old school. That's Gordon discount, dividend discount model type of thing, but it does indicate the direction in terms of PE ratios that they might move if we see a situation of real yields still at 2.40%.
And let's break down what we've seen in terms of nominal yields. As you mentioned, real yields very high, and they've been in the driver's seat, really, if you think about this rise in the 10-year yield. Talk to us, though, about break-evens. Do you think that inflation expectations should be higher here, given what we're seeing in the energy market?
Yeah, I think it should. And, the break-even rate for the 10-year, amazingly, is rather stable between 2 and 2.3% today. I think around 2.34%. And so that's the expectation for inflation. I would say it's more like 3. Getting down to 2 is going to be very difficult going forward. And so, that to me means that nominal treasuries, take the 10-year again, at 4.75 or 4.8, that nominal treasuries are basically based upon an expectation for a 3% Fed funds rate over a long-term basis. There is a equity risk premium that you talked about. There is a term premium for bonds as well of about 1 to 1.25%, because that's the risk of owning a 10-year versus a treasury bill. And so if Fed funds settle around 3 to 3.5%, a 5% 10-year treasury is decent value. It's not great value.
What is great value, though? When you think about 5% on a 10-year treasury, we haven't seen that for 15 years plus. If that's not great, what is great?
Well, it's greater. There's no doubt about that. But 5%, again, would be a normal bond term premium of about 1.25% under 3% inflationary expectations. So that's okay. And I know corporate spreads have widened out a little bit, and that makes them attractive. But what I think has happened, Katie, in the past several weeks, and the market is beginning to recognize Treasury supply, based upon a $2 trillion deficit. They're beginning to recognize, basically the selling of bonds by the Fed in terms of the QT. They're beginning to recognize higher for longer as well. And so those two factors have been important in terms of the current rise. What I've seen in the last week is that the bond vigilantes, to the extent that they are now individuals owning, billions and billions, hundreds of billions of bond ETFs, they've been spooked over the last week or so by declines of 2, 3, 4, 5% in their ETFs. And so I think they're joining the crowd in terms of selling, and we're seeing a little bit of an oversold market here headed to 5%.
Certainly oversold, but I do worry, Bills, about some of these external events. Of course, yesterday there was a lot of hoopla around basically the Speaker of the House losing his position here, and whether this was symptomatic of just the dysfunction in Washington. You mentioned the federal debt. We know debt servicing costs have gone up from sub 2% here for the government to, I think, now somewhere in the 4 to 5% range here on average. How much of that ends up becoming a factor in investment decisions, or can you ignore it?
Well, I don't think you can ignore it. We're going to see the point again 30 days from now, in which they have to vote, and we'll have a new speaker, I assume. But to me, it indicates, disruption in terms of the process, additional disruption based upon what we've seen, because 10 conservative Republicans basically are running the show in the House. And so that will increase volatility in terms of all markets, and certainly is a negative.
So that was the PIMCO co-founder Bill Gross there, speaking to Bloomberg's Katie Greifeld and Romaine Bostick.
Now, we're going to Germany for our next story, where the property downturn driven by higher interest rates is starting to claim some big victims. A swathe of German developers are facing insolvency. That's leaving construction projects in limbo across the country and creditors potentially facing hefty losses. Our distressed debt reporter Libby Cherry has been following this story. Libby, great to have you on. Firstly, what's just prompted this particular wave of businesses to file for insolvency?
Hi there. So it's a bit of a perfect storm, really, when it comes to these developers. So as you said, we've seen this very rapid rise in interest rates, and that's feeding through into higher financing costs for these developers, the loans that they often, take out in order to fund a project to completion. And then on the other side, you've had inflation. So that's increased the cost of building materials, that's increased the cost of labor, and that's eating into their margins as well. And, often they can find themselves at a point where they're halfway through a project, and they're left without the money to finish it. And, at that point, if your lenders aren't willing to provide you with more money, sometimes you face little choice but to file for insolvency proceedings.
So what are the broader repercussions then for Germany's cities?
Well, it's a good question. I mean, these cities, these projects, they can be in the middle of these cities, they can become eyesores. Often construction has been delayed while negotiations are going on anyway. And once you enter an insolvency process, you can find that some of the existing contractors walk away. There's then a problem of having to tender for new contractors to come in. You can start having some of the people that decided to buy the building getting cold feet. And it becomes a political issue as well. I mean, no one wants these, gaping eyesores in the middle of their cities. So you do see some kind of, the mayor's office or some of the sort of local politicians also, getting involved.
Yeah. And so then what are the lenders doing about this? What's their attitude?
So, many of the, a lot of this is kind of bank financing. And there can be situations where, it's in their interest to fund the project to completion. So they might be willing to, in certain situations, provide a bit more new money to kind of get the project to completion, sell the building and move on. But negotiations can become more difficult. You do see, for instance, there might be some of these smaller pension funds which have invested in funding these developments. And for regulatory reasons, they might be limited in the amount of new money they can provide. So, it can lead to quite sort of difficult negotiations for sure.
What's the outlook then for the sector, Libby, given that interest rates are where they are and, as we're being told by central banks, will remain higher for longer?
Well, exactly. I think obviously the sort of macro outlook is quite uncertain, but certainly some of the people that we were speaking to that deal with these kind of cases were saying that they do, anticipate more of these insolvencies going forward. And, as you say, if central bank interest rates stay where they are, there will be this period of adjustment, let alone if we then see some kind of, downturn in the economy as well. I feel that, I think a lot of the responses that we got was this is a business model which relied a lot on cheap financing, but, perhaps in the future we might be able to reach a new equilibrium.
This is Bloomberg Daybreak Europe, your morning brief on the stories making news from London to Wall Street and beyond.
Look for us on your podcast feed every morning on Apple, Spotify and anywhere else you get your podcasts.
You can also listen live each morning on London DAB Radio, the Bloomberg Business app and Bloomberg.com.
Our flagship New York station is also available on your Amazon Alexa devices. Just say, Alexa, play Bloomberg 1130. I'm Caroline Hepker.
And I'm Stephen Carroll. Join us again tomorrow morning for all the news you need to start your day, right here on Bloomberg Daybreak Europe.
We bring you news and analysis every day on the Bloomberg Daybreak Europe podcast, but now you can hear the latest news on demand whenever you want it. Subscribe to Bloomberg News now to get the latest headlines at the click of a button. You can listen and subscribe to Bloomberg News now on the Bloomberg Business app, Bloomberg.com, plus Apple, Spotify and anywhere else you get your podcasts. Search Bloomberg News now and subscribe today.